Joining me today in the house here on Wall Street is Jeffrey Gundlach. He's the CEO, CIO, and founder of DoubleLine Capital. It's nice to have you in our house for a change. Welcome.
It's good to be here again. I haven't been to the stock exchange. Well, I was here yesterday for a client meeting, but it's been years.
Well, it's good to have you here. Your reaction, first and foremost, to what we just heard. I think the headline really is obvious today, and it is this tension that may exist between the two mandates that the Fed has.
Yeah, and we've talked about that last couple of times that we've met on Fed Day. I think the word of the day in the press conference is uncertainty. I mean, he said it's too early to know, don't think we know, phrases like that all the time. So I can't really blame them. I mean, we are in sort of uncharted waters we don't know what the tariffs are going to do to inflation. There is pressure a little bit on the rising unemployment rate, which I'll talk about in a little bit. Mm-hmm. But I really felt he did everything but invoke the Hippocratic oath regarding the Fed funds rate. Above all, do no harm. Right, because he says we're in a good place over and over again.
Over and over. He said that multiple times in exactly those words or versions of.
Yeah, but he refuses to answer, and I can't blame him for this either, questions of what would the unemployment rate have to go to, which one's going to be a problem first, and so forth. So he says wait and see. We're in a good place, we can wait and see. But I think that it's a little bit of uncertainty. I'm surprised the market didn't act worse on the stock market, because it sounds to me like we're back in Mr. Magoo land, where we're in the car driving around, and he admits that there's risks, higher inflation, higher unemployment rate, but he says, I'm not going to, I can't explain to you what we need to see to get concerned about one side of the mandate or the other, so we're just going to wait and see which tree we bump into. So I feel like we're going to bump into either a tariff inflation tree, we're going to bump into a rising unemployment tree, and that will affect what happens to the Fed funds rate down the line. But the unemployment rate is rising. I mean, it's above its 36-month moving average, and that goes along with recession. It's also, the unemployment rate is also above its 12-month moving average, and the 12-month moving average is important too. But also the 2s, 10s, the yield curve, which was inverted for so long, and now it's de-inverted, which usually puts us on watch for economic problems. But the 12-month moving average of the 2s, 10s is now positive, which has never happened without a recession after a period of inversion going back to 1980. So we're watching that very, very carefully to see what happens in the unemployment picture. But the game plan is still largely the same for us. We've been in a trading range for interest rates across the yield curve for quite a while now. I mean, Powell himself said the 10 years where it was 2.5 years ago. And it's true that the long end of the curve is performing unusually for what's been something of a Fed easing cycle. You know, we've had 100 basis points of cuts, and yet long rates are up. That doesn't happen typically. And this, I think, continues to feed into my thesis that as the economy weakens, long-term interest rates could very well be going up. And that's very different from most people's experience. Even if you have 40 years of experience, like I do, most people say when there's a recession, the dollar goes up and interest rates go down. But actually, the opposite has happened this time. And I don't think that that's just a coincidence or a one-off. I think that's going to continue because the interest expense on the debt, which we always talk about, is just horrifically bad, and it's going to $4 billion a day, and I don't know what we're going to do to handle that other than maybe we're going to talk about some really exotic policies might have to be brought in if long-term interest rates do not drop or even rise in the face of economic weakness. We might have to do yield curve control, which we did in the 1940s and early 50s. They did it in Japan for a very long, long time. We'll see what happens. But we continue to be, and I think when I talk to our big clients, they say, everyone says what you're saying, that we want to be more liquid, we want to be up in credit, we don't want to be in the long end, we think the curve's going to steepen. And usually when you have that kind of a consensus, you're at a turning point, but it's not happening. These trades continue to work. Up in quality is certainly working. Lower quality junk bonds, the triple Cs, are now up very significantly in yield, and the yield spread between double B, the highest quality of high yield, and triple C is above its 200-day moving average, which is a really bad sign.
You said the last time that we spoke that I believe this is correct, that you had more cash than you've had in a long time, if not ever, at DoubleLine, and that it was too early to deploy it. Now, we were going through a pretty rough market period when we last spoke in early April. Here we find ourselves in a different scenario today. So how does that sit?
I feel like we're in a risk-off market as on an intermediate-term basis. And I think what's really interesting is through all the volatility that you had in risk assets and some parts of the bond market as well, the one thing that hasn't had much volatility is gold. Gold broke out above 2,000 and went to 3,000, and now it's like 3,400. It hit a new high yesterday. It's down today. But I think that's telling us something. I think that's telling us that we're in a regime where gold is no longer a speculation for short-term traders or for survivalists as a long-term hold. I think people are viewing gold as an asset class out of fear of the turmoil that's going on geopolitically with the tariffs and everything else, and just the amount of debt that exists, that people wonder how we're going to deal with it. So gold is sort of the true monetary asset. So I find it very interesting, and I still think that gold is headed to 4,000. I think I said that back in April. I think you asked me, is it going to 3,000? I think it was just below it, and I said, that's not much of a forecast. I think we're almost there. It'll probably go to 4,000. So I think that you're going to get a breakdown. When we spoke in April, I was targeting a support band for the S&P at 4,500. I still think we're going to get there, or maybe a little bit higher, maybe 4,600 or something like that. That's where I would really start to think about deploying money for a little bit longer term period. We don't invest at all for 1 month, obviously.
Sure.
We invest typically for about 18 months to 2 years is what we sort of think about as investment horizon, particularly for fixed income. Where we don't really trade as much as a lot of our competitors. We think you have a better chance of seeing things looking out 18 months to 2 years. If you look out longer than that, you can have even more certainty. The problem is we're managing other people's money. And if it takes too long, you can't underperform for 5 years and keep your clients. You have to deliver them something reasonably good over an 18-month, 2-year period, and that's what we're trying to do. The thing that I feel is starting to get talked about, and I think might be significant in the next market problem, is this illiquidity issue that is developed, and it's getting some play on the news wires with Harvard and some other elite universities where they don't have any money. They're like asset rich, but they're cash poor. So Harvard has a $53+ billion endowment, and they've tapped the bond market now twice for basically operating cash. And the reason is, and I'm just using Harvard as a placeholder because this has been in the news and reported with statistics, they report 40% of their assets of their endowment in private equity. And I suspect that another big slug of it is in private credit, which has been a booming asset class. And we're starting to see stories of some of the faster moving university endowments saying, we might want to exit some of our commitments. We know we're going to have to take a haircut, but your first loss is your best loss when you're in an illiquid market. I think this is going to be an issue. And I believe that the probabilities of this is increasing because of that spread between BB and CCC. Mm-hmm. That signals to me that a lot of the junky stuff is starting to feel stress, and a lot of the really junky stuff went to private credit. So now we're even seeing the bell being rung almost with some people championing, let's raise a fund to buy private credit interests or private equity interests, and beyond that, let's make this available to the public. That's when you have to worry, is when you take something that's viewed to be an esoteric thing only for professionals. You say, this is such a great deal, we want to give it to Main Street investors, and we're going to commingle a fund. That's a real problem when you take illiquid investments and put them into vehicles that can require liquidity.
The biggest names in that business, since we're on that topic, most of them were just out at the Milken conference, out in LA. And are still sort of defending private credit, obviously, and almost scoffing at the notion that there's a budding problem, that it was a bubble. People like John Gray and others continue to make that case. You told me last September when we were at Future Proof discussing this that you thought there was a top at that point in private credit. You seem today...
private credit is underperforming public credit since that time period. I think it's underperformed for a short while. But when people defend private credit, they use three arguments, which all three of which I think have flaws. The first is they use a Sharpe ratio argument that, yes, it's illiquid, but it's really less volatile than public credit, which doesn't make any sense to me at all. What happens is you just don't market to market as frequently. So if the S&P 500 goes from 100 to 50, private credit might get marked down to 80. And then they both recover to 100, and they say, look at this fantastic risk-adjusted return. It's the same as the S&P 500 with less than half of the volatility, so it's a Sharpe ratio argument. I just don't think that they're being accurately marked all the time. We have clients that use a lot of private credit, and some of them have many, many managers in it. And the private credit world is a clubby area. It's people that they get together with their competitors, actually, and they make a group that does a deal. So there's a $5 billion deal, and they get 10 firms together to do $500 million each. Well, this one client of ours had 8 managers that actually owned the same position. They were in part of that club together for that deal. And they were kind of shocked that at one year end, I think it was just recently, the last year end, or maybe it's the end of March, they said one of the managers had the position marked at 95, and one of them had it marked at 8. It's the same thing. So that might be a very extreme example, but that gets to the notion that I'm talking about. The next argument that's used is a true argument, but I'm not sure, as they say, past performance may not be indicative of future results. It's that the trailing numbers for private credit are fantastic. They're way better than public credit. That's what draws all the money in. But it hasn't been lately. And so I worry about projecting the past into the future as there's a booming market that's really kind of untested. And the last argument is the worst of all. I was at a conference speaking, and the person before me was promoting private credit. That was the focus of this person's firm. And she said the beautiful thing about private credit is when the markets get volatile, and this was fairly recently, so people were thinking about volatility, owning private credit lets you ride through the storm of the volatility in your public credit. Again, it's a volatility argument that I just think it doesn't really hold up. So this reminds me a little bit of, oh, it's only subprime, it's small, it's contained, and there's no issue. And then all of a sudden you realize that there's tremendous knock-on effects to other areas. So
but you have some really, really smart and successful investors I'm talking about. The Rowans, the Arroghettis, as I said, the John Grays.
In June of 2007, I gave the keynote at the Morningstar annual conference, and I said subprime is a total unmitigated disaster and it's going to get worse. And it raised a lot of eyebrows, and speakers that followed me who were very smart, very accomplished, kind of in the category of the names that you're speaking of, said I was dead wrong and there's absolutely nothing to worry about. And that kind of made my reputation because I was one of the very few people that saw that. I'm not saying this has to happen. I'm saying that it's an issue that is on my radar screen, just something to watch for.
Some people do suggest that this is the first real test of private credit because the economy weakening, the trade war, and everything else in this environment is going to be
Look at these university endowments that have to tap the bond market to get operating cash, because if with Harvard's case, over $53 billion, they couldn't get $1.6 billion out of $53.8 billion endowment. This is, I just look for, in my job, particularly as a kind of a dour bond guy, my job is to find 10 problems for every 3 that exist, because that's really the essence of risk management. And we started on upgrading credit and raising cash and so forth a couple of years ago. We have our lowest leverage of all time. And that's because we want dry powder, and we can Also, the yield curve is so flat that the leveraging doesn't really work as well as in a steep yield curve. But we believe in dry powder for another leg down on risk assets.
The biggest question, I think, from today, we got the headline, and Steve Leisman's made his way out of the room, is, Steve, which way will the Fed lean first? You tried your best, and Jay Powell just doesn't know. He said, I don't think we know. And then he later said it's a complicated and challenging judgment that will have to be made if unemployment rises and inflation at minimum stays where it is. What do? They don't know.
The answer is which way, to the question, Scott, which way do they lean first? The answer is yes. That's the correct answer. They don't know. Look, Scott, I can take this whole 45-minute press conference, wrap it up in a single question, which I said, which way do you lean first? And here's Powell's answer.
I don't think we can say, which way this will shake out. I think there's a great deal of uncertainty about, for example, where tariff policies are going to settle out. And also, when they do settle out, what will be the implications for the economy, for growth, and for employment? I think it's too early to know that. So, ultimately, we think our policy rate is in a good place to stay as we await further clarity on tariffs.
That literally, Scott, is the entire press conference. The rest, as they say, is just commentary. And the only salient thing here from the statement was that the Fed saying the risks have risen on both sides of the mandate. There's an equal amount of risk for higher unemployment and for higher inflation, and that's what the Fed has to deal with and is just waiting to shake it out. And it's not, according to the last question, which is worth summarizing here, Scott, not going to make a call on the sentiment data or the soft data. It's going to wait till it shows up in the hard data. And I'll just add this idea of, yes, the Fed is going to be behind the curve, but as Jason Furman said in a New York Times piece, that alleviates the risk of getting in front of the wrong curve.
Interesting.
That's right. That's that Hippocratic oath thing again.
Yeah. Steve, thank you. Good points, of course. I'm going to ask Jeffrey about it now. Steve Leisman, who asked really the question of the moment today in that meeting.
I thought it was great that he got the first question, because Steve's exactly right that question was asked by him directly. The answer was obviously, as Steve said, just that's all you need to know on the entire press conference. And there had to be half a dozen others that tried that same question and got basically the variation of the same answer. And basically they say, we don't know. There's too much uncertainty. That word was used a lot. We can't even tell you what we're looking for, but we'll know it when we see it. And know it when we see it means it has to be eye-opening enough that you've bumped into a tree.
Are you suggesting that they should cut rates now because of the
I don't
employment
think they
data that you think is telling a bad story?
I think that our inflation model, which should be relaxing because it incorporates energy prices pretty meaningfully. Energy prices are very low, WTI down below $60. And yet, when we make our best guess, and this is tricky, as Jay Powell says, to figure out the tariff effect, you make some assumptions based upon what's said, and then you have to make them again because something else is said. But we believe now that the base case is the CPI headline, based on conditions today, which of course it's a fluid situation, will probably end the year with a 4 handle. And a 4 handle doesn't sound like 2. And Jay Powell is a little disingenuous when he said something like surveys or market data says that.
Yeah, the soft data.
No, I'm talking about inflation expectations. He says that he used the soft data and he said it's actually beyond 1 year. For periods beyond the first year, it's not really higher than 2%. It's contained. But that's not true at all. The University of Michigan, they do an expected inflation survey, and the 12-month inflation expectation in that survey's the most recent reading is in the mid-6s for 12 months. They also do a 5-year guess by these people, and it's up to 4 into the mid-4s per annum for 5 years. So it's not true that inflation expectations beyond 1 year are anchored. And also market pricing for 1 year is 3% for the next 12 months. Neither of these sound anything like 2. So I just don't think they should be cutting rates against this backdrop, if they cut rates and inflation rises, I think you're going to have a real problem at the long end. This is the trade that almost everybody seems to have on. It's working. The curve has gone from 2s, 10s, from negative 108, to positive a significant amount. And this trade has been working, and I think it will continue to work. But my fear is if the rates get uncomfortably high, that there will be some sort of exogenous shock from the government, from the Treasury Department or the Fed, that they might do yield curve control, they might talk about other things. And this is going to be really hard because this trade has been working, and it's always easy to play another day when the trade's working, but you've got to, the hardest thing in the investment business, Judge, is to change your portfolio in some significant way after you've been right. Because being right is very satisfying economically, psychologically, your clients are happy, but at some point you have to pivot. And I think this curve steepening trade, based upon supply fears in the bond market, will get to a point where it causes a reaction, and you're going to get a rally at that point in long bonds, and it could be quite sharp. When you get some of these announcements, you get these V-shaped things in markets that have been on an extended trend. And I spend a lot of time thinking about this because I, like everybody else, have a steepener trade on. We put it on at a very good time. It's working. We don't really like the long end, and we continue to be focused in higher credit, like double B, single A, maybe some single B. We're trying to stay out of anything that starts with a C, and we've been upgrading that systematically. So we have very low risk positions at the bottom of the capital structure, and the long end in particular, and it's been working well. So we just can't get complacent about it.
Do you think they're going to cut this year?
Our last time we spoke, I said I think they'll cut twice. The market has been pricing in much more than that almost all the way through this year. We've had times where there were 5 cuts priced in. I think now it's at 2.5 over the next, we've only got a little more than half a year going here, not that many more meetings. I do think they'll cut rates, but I don't think it's going to be because of much better inflation data, because I don't think it's going to get much better. I doubt the unemployment rate is going to be a shocker in the near term, like in the next few months. But I do think they'll cut rates because of some illiquidity problems that may come up. So I do think they'll probably cut rates by year end. And I still think it's probably less than the market thinks, but I'm closer to the market now because I've stayed at 2, and the market has gone from 5 or 6 down to 2.5.
But you sort of are answering the question of the moment as well, one that Jay Powell can't really answer, doesn't want to now. When you talk about the unemployment rate getting worse, that is the side of the mandate that the Fed is going to lean to first.
Yeah, that would be my guess, that they're likely to get worried about the unemployment rate more than worried about the inflation rate. Although Jay Powell did say something really interesting that I don't know if anybody heard him say, because he only said it once. He said, we'll have to see if an inflation increase is a one-time increase, which to me makes it sound like he thinks that's possible from the tariffs. What else would we be talking about?
No, he's talking about that because he's made that case before, that their sort of base assumption is you get these one-time increases, but we're not talking about something that just goes on, forever as a result of these tariffs. These tariff policy could be rolled back in anybody's guess.
Well, we haven't even seen what it is yet, let alone what to be rolled back. It keeps changing all the time. But he's going to put tariffs on, and I think he's going to be I don't think he's going to get worried about the market that much. I think Trump cares much more about taking whatever pain he needs to take now rather than 7 to 8 months from now when it's staring down the barrel of the midterms, where an economic fallout could have really serious consequences for the Republican Party. It's kind of like when Reagan came in. I don't know if Reagan really did anything, but Volcker did it to him. And the inflation rate was so high, and the economy went into that recession that really lasted about 3 years. It's officially 2 recessions. They claim there was a respite in the early 80s, but it's really, I lived through it. It was really one recession. Reagan took the pain. People thought he had no chance of winning re-election, and then he won in a massive landslide. Come the next one. Now, Trump doesn't have that 2 extra years because he can't run again, but he needs the Congress to be tilting Republican to get anything done in the second half of his term.
What do you make of the questioning of the so-called American exceptionalism trade, which really came to the forefront as we went through that episode where bond yields had backed up dramatically in a really short period of time, and a notion that what was to be, the safe haven place to be for money investors here, but globally, maybe not so much, and the dollar plays into that story too. What's your take?
I think the so-called American exceptionalism trade is really nothing more than a momentum trade, observing that money has poured into the United States from overseas over the past, say, 18 years. The net investment position in the United States was negative $3 trillion 18 years ago. It means that foreigners had $3 trillion more invested in the U.S. than we had invested in them. That number has grown up to, by one measure, 28 trillion. So it's increased by 25 trillion in 18 years. That's a trillion, almost $1.5 trillion per year. And given the tensions that are going on now, and given that Europe is outperforming, which I've talked about as being a really good trade, that's doing great for dollar-based investors this year, I think that the momentum trade may start to unwind. And money may come out of the United States and go into Europe, who has to think about their own defense now, has to reindustrialize in Germany, maybe South Korea, other people that we put tariffs on. I think the money, it's quite possible that, say, I don't know, let's just pick a number, 5 trillion, 8 trillion, 10 trillion could go out of the United States. They might be repatriated to other countries. That's a huge selling. One of the reasons the U.S. has outperformed, it's been a momentum trade, but Europe has now outperformed the U.S. since we bought Europe selling the S&P back in 2022. Europe's outperformed for the last 3 years for dollar-based investors. So I think I keep recommending that investors think about the dollar, in my opinion, will go down as the economy weakens. Everyone says that's nuts because they have experience. They say when there's a recession, the dollar goes up and bond yield goes down. That's not happening now. The Fed was encouraged to ease interest rates because, for whatever reason, by 100 basis points, I think the 2-year was yelling at them that they were too high, but yet the dollar is down since then, and bond yields are up since then. So I think the dollar is going to be under pressure in the next recession, and that's going to be a real reason for investors to think about more diversified investing. I've talked about having much less weight in the United States than in Europe, and of course I always like India as a very long-term hold for my own money. But I think that's going to be a trend that lasts, because the trend for the dollar momentum lasted so long, so powerful. The valuation, if you look at U.S. S&P, U.S. stocks, and all the rest of the world, ex-U.S., so the whole rest of the world stock market, just compared to the U.S., there were 2 periods that were considered to be absurdly overvalued in the United States. The highest period was in the early 70s, called the Nifty 50. And it had gone up about 100% versus the rest of the world. The second one was in the dot-com situation in 1999, which wasn't as egregious as the Nifty 50. But now the valuation, that after this long move of so-called U.S. exceptionalism, this valuation is double what the Nifty 50 was. Versus, as overvalued as people thought, this is nuts that the Nifty 50 market was so high versus the rest of the world. We're twice as high and already rolled over. So this is an interesting time period for people to pull the trigger on some of these longer-term themes that are starting to actually reveal themselves in real time.
Do you agree with those who, like Ken Griffin, who, by the way, is coming up in the next hour with Sarah Eisen, and Mark Rowan, I mentioned his name as it relates to the private credit conversation, who suggest brand damage has been done to the United States as a result of some of President Trump's policies. Do you agree with that? It's almost like you're painting that sort of picture when it comes to capital flight.
Not really. I think brand damage is contained to the ideas of entrenched, powerful elite people who like the way the system has been running. When people are the beneficiary of a long-standing system that is starting to get creaky because of wealth inequality and other financial issues and the like, the people that are benefiting from all of that don't want it to change. That's why nobody wants Doge to cut anything, because it's their waste corruption that they want that might be cut. People like cutting in the abstract. Waste sounds bad, so let's get rid of it. And then but when you identify it, they say, wait a minute, you're cutting me. You're cutting you. No, don't cut you, don't cut me, cut the guy behind the tree. That's just a theoretical construct. So I think the elites don't want the United States to get its trade deficit down, because they benefit from it. I think a lot of people don't want the budget to be cut at all because they're benefiting from it. I mean, what was it? The light rail to nowhere that was planned in California was supposed to cost $33 billion, be in place by 2020, and run a high-speed light rail between San Francisco and Los Angeles. Today, it's now already cost $128 billion. So $33 billion, not 1 inch of track has been laid. It's now down to 177 miles instead of 780 miles. How did it go from 33 billion to 128 billion by building almost nothing? Somebody greatly underestimated the cost, or there's a little, cushion built in for, I don't know, overcharges.
So you agree with what the administration is trying to do, and what do you think the ultimate outcome is going to be?
I think it's not going to come to enough in the way of cutting. We have in the first half of fiscal 2025, which ended March 31st, we had a deficit of $1.3 trillion. So that's an annual rate of $2.6 trillion. That's about 9% of GDP. The CBO is using an estimate of like 5 or 6 for fiscal 2025. We're already on a track to 9. We really can't get down to this 3-3-3 concept. It's not coherent to me. We're not going to get the deficit down to 3 and have 3% real growth. That change in the deficit is part of the the GDP equation. If you go from 9 to 3 over a 3-year period, you're cutting out 200 basis points per year, 2% per year. How are we going to go from like 2-ish real to 3 real when we're facing a tractor pull of 2 the other way? I just don't see how it's going to work. So I think it's well-meaning, but I feel like we've gone on for too long with this scheme, and I've talked about this, and we're going to have to do something fairly radical. Either yield curve control, which there's precedent in the United States and much greater precedent in Japan, or who knows. I did hear there was a paper that was put out last fall, and Scott Besson actually referenced it a few weeks after it. He said maybe we should tell foreigners that their treasury bonds are being extended to some longer maturity. He didn't specify, but I'm sure it's not a 1-year extension, and we'll cut their interest rate that we pay them. Well, that would be a riot, of course, if that happened. But the fact that that's even being discussed by the Secretary of Treasury means something like that actually could be in our future.
We'll leave it there. It's great having you here with us, Jeffrey. Thank you once again, and we will see you after the next Fed meeting.
All right. As always, good luck, everybody out there. It's going to be an interesting second half.
It is, indeed. Jeffrey, thanks. That's Jeffrey Gundlach here with us at Post 9.